The following is the monetary policy statement for June 2015. Inflation continued to rise in May 2015, with annual core inflation edging up 4.8% from 4.6% in April 2015. The rise in core inflation was part driven by the pass-through effects of the exchange rate depreciation, was in part driven by the pass-through effects of the exchange rate depreciation. Annual headline inflation also rose to May 2015, in May 2015 to 4.9% from 3.6% in April. The main contributions to the May headline inflation came from the categories of services, which accounted for 2.4 percentage points, other goods, which accounted for 1.7 percentage points, and food crops, which accounted for 0.9 percentage points. Aggregate demand has improved through exports of goods and services. Aggregate demand has improved, though exports of goods and services remain depressed, which is a key drag on aggregate demand. Indicators of economic activity point to relatively strong real GDP growth in the fourth quarter 2014-15, supported by faster economic growth, in private sector borrowing and a recovery in the agricultural sector. Real GDP growth is projected to 5.3% for 2014-2015 and at 5.8% for 2015-16, driven by higher public investment, which was announced in the budget, and a rebound in private sector demand. The domestic borrowing requirement in 2015-2016 is no larger than that of 2014-2015. Bank of Uganda believes that the more expansionary fiscal stance of 2015-2016 budget will support economic activity and economic growth and will not threaten macroeconomic stability. Pressures on the exchange rate have persisted since the beginning of 2014, reflecting global financial conditions as well as weak balance of payments positions. The current account deficit is projected to widen 10.3% of GDP in 2015-2016 from 8.4% of GDP, 8.4% in 2014-2015 on account of higher non-oil private sector imports, and public investor-related imports. Lower personal transfers and weak exports owing to subdued global commodity prices and income and low aggregate demand in export markets were also factors. The government of Uganda's the Bank of Uganda's conditional inflation forecast has changed since the previous meeting of the Monetary Policy Committee. The exchange rate pass-through effect and the strengthening of economic activity, both at home and abroad, will exert further upward pressure on consumer prices over the medium term in the absence of further tightening. Annual core inflation is now expected to rise to 8 to 10% by the end of 2015-2016, an increase of 1 percentage point compared to April 2015 forecast. Much of the increase in core inflation is attributed to a currency depreciation and inflationary expectations. In the circumstances, an increase in the central bank rate is appropriate given high inflationary pressures and the expected strengthening in demand, and also to ensure that medium-term inflation converges towards the Bank of Uganda's policy target of 5% during the course of 2016-2017. Therefore, the Bank of Uganda will raise the central bank rate by 1 percentage point to 1.3 percentage points, to 13%. My eyes are a problem. Therefore, the Bank of Uganda will raise the CBR rate by 1 percentage point to 13%. The band on the CBR will be maintained at plus or minus 2 percentage points, and the margin on the rediscount rate at 3% percentage points on the CBR. Consequently, the rediscount rate and the bank rate will be increased to 16% and 17% respectively as from today. Bank of Uganda will tighten monetary policy further should there be a deterioration in inflation outlook and a further need to tighten policy more. Here ends the monetary policy statement for June.
Thank you.